Are you ready to take your first steps towards financial freedom by investing in property? Whether you're a first-time investor or you've started your portfolio but need some help continuing to grow, 2022 REB Buyers Agent of the Year and Rising Star finalist Lachlan Vidler and his team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take your next step in growing your portfolio. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment property. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hello, everyone. Welcome back to a brand new episode of the Smart Property Investment Show. I'm Grace Ormsby, and you've probably already heard about the recent rate increase from the Reserve Bank of Australia. They've lifted it a massive 50 basis points from 0.35 to 0.85%. And for a lot of people, this is, a bit of a shock. There's a lot going on. Obviously, it's going to have an impact on people's mortgages moving forward. And then there's going to be a flow-on effect into the property market. But we decided that we needed to be talking to someone who was a little bit of an expert in this area. So it's an absolute pleasure to be welcoming Rate City Research Director Sally Tyndall onto today's show to talk all about it and explain what it actually means. Sally, thank you so much for your time.
Oh, thanks for having me, Grace. It's so lovely to be on your podcast.
We do love reading your commentary each month when the rate decision is released. And we do, love using that and incorporating that commentary into what we report on the day. But I thought it was about time, especially given that we have just seen such a huge lift, to get you on the show to actually unpack what this means. I think, especially in the property market, there's going to be some pretty big ramifications, not necessarily good or bad, but it's just part of an economic cycle and what's going on. Before we get into your expectations around the rates and what's going on, can we just unpack a little bit about what, in the scheme of things, what happens to cause the Reserve Bank of Australia to make a decision to either lift or drop the rates?
That's a really good question, actually. We're going back to core economics. But one of the key KPIs, the primary KPI for the Reserve Bank, is to keep inflation in their target band. Their target band is 2 to 3%. And inflation is well above that, as most of us know. It's sitting at 5.1%. I think underlying inflation is 3.7%. So one of the key levers to get that inflation back under control is to lift the official cash rate. The official cash rate is actually the rate at which banks swap money overnight, but it really does set the benchmark for particularly variable rates to a much lesser degree of fixed rates for the banks and for the economy. So they have hiked the cash rate. We need to point out that the cash rate was at record lows for so long now. It was at 0.1 and only got lifted for, the first time in well over a decade in May, and now the double hike in June. That brings the cash rate to 0.85%, which is probably just above emergency setting levels even still. Governor Lowe has said that he thinks that the new neutral cash rate will be around 2.5%. Historically, that's actually still quite low, but that's what he's indicated. And there's a long road to get to that point, although with this double hike that we've just seen this week, you can see that the board is determined to get there, perhaps quicker than we were expecting.
Were you expecting this, Sally? I know that with the commentary that you did come out with, it was one of the settings that, was being discussed, but was it really within that realm of, what you expected to happen? Or were you sort of expecting something around the maybe 0.25 to 0.4% range?
Well, we learned from last month to do the maths on quite a few different possibilities. So we had the maths ready to go, which was nice. But no, I was not expecting it. I was expecting a 0.4% hike. I did think that they were going to get cracking with this job, but I didn't think that they were going to crack the whip so hard. Look, he's being entirely practical about it. I think we're a little bit fixated on the fact that he needs to, or the board needs to get back to those 0.25 increments that we're used to seeing, so a more even number, if you will. But I think that the Governor Lowe and the board is far more practical and is just looking at getting the job done rather than a particular number. But yes, and what surprised me the most in Tuesday was that all four big bank economists, they came out and revised their cash rate forecasts, and three of the four economists, so the economists from CBA, Westpac and NAB, all now predict another double hike next month. So they really are putting their foot to the floor.
It does seem crazy, doesn't it, considering how low rates stayed for so long? How effective then is the cash rate measure at actually solving is probably not the right word, but, working as a lever to fix the problem with inflation that we're seeing?
Well, it's interesting because we're in uncharted waters. The things that are affecting inflation at the moment are different to what they were last time that the RBA hiked the cash rate back in 2010. So, yes, they're very conscious of that. There's, in some cases, some prices will naturally come down and others may stay high from here on in. And so I don't think even the RBA knows how effective these cash rate hikes will be. But what is important is to get back to a more normal level. Regardless, it will have an impact, these cash rate hikes. But, there's also a job to be done to get that cash rate back to a more normal level. We can't have uber cheap money forever, unfortunately. It just doesn't quite work like that. The thing is, a couple of other factors that will be weighing on their mind. Firstly, our estimates from the Big Four Bank half-yearly reports are that around 38% of people with a mortgage at this point in time are on a fixed rate. They're not feeling these rate hikes at this point in time. When they come off the fixed rates, and Big Four banks predict that the peak of people coming off fixed rates will be around July to December next year. When that happens, they'll be in for a big shock because their rates will in some cases double, if not more. But at this point in time, they're not feeling anything in their monthly repayments. But also on the other side of the coin, you've got a lot of borrowers who have taken on giant levels of debt compared to their income. The latest data from APRA shows that in the December quarter of last year, that 1 in 4 loans approximately were taking on risky levels of debt where the person's debt to income ratio was 6 times or more. And so that's obviously going to have a big impact on their finances because they don't have as much wiggle room in their budgets to pay for these rate hikes. Of course, I will point out, though, that if someone has just recently got into the home loan market, the bank has stress tested them, and they have stress tested them to make sure that they can meet their monthly repayments if rates rose by 3%. And that's an increase from the previous stress test of 2.5%. So in theory, these people should be able to meet the repayments.
Good to know. We're going to take a quick break there. We'll be back in just a moment with more from Rate City's Research Director, Sally Tyndall.
Ever wondered how you can invest like the top 1% of Australian property investors? Henderson Advocacy has been at the forefront of helping everyday Aussies improve their financial freedom. So if you're a savvy investor or someone just starting out on their property journey, give Henderson Advocacy a call today. Head to www.henderson.com.au. Don't invest alone. Invest smarter.
Welcome back to this very special episode. We're joined by Sally Tyndall, the Rate City Research Director, who has already been giving us some great insight into what the RBA's decision to lift the cash rate to 0.85% will actually mean. And Sally, at this point, I'd love to bring in a little bit more about the impacts on the property market as a whole and what we can kind of see already happening, obviously, over the last couple of years. Property markets across the country have seen huge increases. And this has been brought about in part by the cash rate being so low, people having access to cheaper money and not having to pay so much interest on those loans. What are you already seeing at the moment? Because I feel like from my perspective, looking at the property market, we've already seen a bit of a stall. The price growth that has been on offer over the last couple of years, it's been curbed now by rising costs associated with mortgages and even just people being a bit more scared or worried about whether they can actually sustain mortgage repayments at such high levels of property value.
Yeah, absolutely. The market certainly has the wobbles in Sydney, Melbourne and Canberra. If you look at the latest CoreLogic figures, you've seen drops in those three capital cities, and we expect other capital cities will follow this trend in coming months. And in the lead up to these cash rate hikes, you could see clearly fixed rates were on the rise. It's like a canary in the coal mine, fixed rates. And so that was giving people a warning that we might be nearing the peak of the market, that it might be time to put your property buying plans on the shelf and just see what happens. In the latest ABS lending indicator data, it was out this week, but it's data for April, we could see that investors took a step back and they took a big step back in the scheme of things. It was the biggest drop since May 2020. When you think about what happened back in May 2020, that was when COVID had just started. We still didn't really know what would come of it, and the forecasts for the property market were for big drops. Obviously, they did not happen, but you can see that's what's getting investors stepping out of the market, is this idea that we could be at the peak and that property price drops are coming.
And bringing in the owner-occupiers there, the ones that you have mentioned previously that they should still be okay based on all the stress testing and everything. But it is interesting to note that, so many borrowers haven't really experienced a rate rise in a decade. So there's a lot of people, first-time home buyers over that time that are now suddenly going, oh, I've actually got to pay attention to what's going on with my mortgage and with the rates and what's happening broader economically, because I'm going to start paying for that. Is that something that people need to be taking note of?
Oh, absolutely. And so what we've been saying, particularly in the last week or so, is work out what rate you're on. A lot of people don't even know, especially in a rising rate environment. It's hard to keep track, right? So work out what your rate is and then stick 2.5%, even 3% on top of that rate, and have a look at what that rate means for your finances. So get a calculator and, one of those online calculators. We've got one on our side, and work out what your monthly repayments might look like when the cash rate gets to 2.5. Potentially, get a buffer, work it out in 3% as well, just in case. And if that number doesn't sit in well with your budget, you really need to think about making changes now. I don't think it's worth taking action in Christmas of next year. It could be too little, too late. Now's the time to start thinking about how you might change your budget to make sure that you can keep those monthly repayments up, because that's critically important. Obviously, there will be some people that have to go onto the bank's hardship policies that won't be able to make those higher repayments. And the banks have really good hardship policies in place for this very reason. But with a bit of planning, hopefully, most people with a home loan can still meet those monthly repayments, provided they make cutbacks elsewhere. Things like rotating entertainment subscriptions, having fewer dinners out, less takeaway coffees. It sounds terrible, doesn't it? It's a bit sad. But, trying to find ongoing relief in your budget, not just one-off expenses, but also wages are forecast to step up in the next year or so, but that's meaningless unless you've had a pay rise. So ask your boss for a pay rise. It's an awkward conversation, but it's one that will pay handsomely from, every month after that if you do. But also don't overlook your mortgage. It's the biggest monthly expense for many families around the country. And even though rates are on the rise, now still is a good time to refinance. Banks still want new business coming in the door. And so if you're prepared to do a bit of paperwork, you can potentially get yourself a rate cut now that will help soften the blow of the rising rates that are likely to snowball from here on in.
Some really good points to make there, Sally. And I would like, if possible, to turn our attention now to the people that are maybe looking to get on the property ladder now. Is it a good time? Is it a not so good time? Does it really depend on where in Australia you're living, considering we are seeing that two-speed market coming into play? Obviously, we're not here to be offering advice to anyone, but do you have any thoughts on anyone who is sort of, ready to get into the market now? Because we are going to see some quite different economic drivers and changes moving forward.
Yeah, absolutely. And I think the advice is that do your research, really. No two circumstances are the same. No one can say blatantly it's a good or bad time to buy without knowing your personal circumstances and really putting themselves in your own shoes. And so, you've got to work out what you're looking for in your purchasing plans. You've got to work out what your budget's like, all sorts of things. People might see the dream home and know that that's for them and jump right in. But as provided you've done the research, that's so key. Understand the environment we are in where rates are on the rise. They'll continue to be on the rise for, at least the next 6 to 12 months, I would say, I guess, or 6 at least, I'd say, and understand what that means for your purchase plans, for your budgets, for property prices, all of them, and put that all into this big life equation to help you make a good decision.
Some great insight there. We're going to take another quick break, but straight after that, I want to hear a little bit more from you, Sally, about, what your expectations are for this timeline of rate hikes, because it's obviously great knowledge to have, and just some more thoughts on what could be happening in the property market of the future. We'll be right back.
It's time to get help. Interest rates are increasing. Inflation has hit an extraordinary 5.1%, and the chance to secure a golden egg property is getting narrower by the day. Dragan from Buyers Agency Australia has been presenting the facts and helping property investors make smarter, well-informed, educated decisions in property for years. So what are you waiting for? Get in touch with Dragan today at www.buyersagencyaustralia.com.au. Invest with integrity.
Hello, everyone. Welcome back to this episode where I'm unpacking the latest RBA decision that was handed down this week on Tuesday, the 7th of June, of a rate rise of 0.5%, 50 basis points from 0.35% to 0.85%. Pretty big move, Sally, one that not many people were expecting, but it's obviously going to be having an impact on people's payments for their mortgages moving forward. And I know that you've done some maths on this and what that actually means. And I think it's worth just outlining what those figures are for people who maybe, as we said, they don't always know their rate, what rate they're sitting at with their mortgage, and what extra money they probably should be setting aside for these expenses, given that it's probably only going to be increasing in the coming months. So can you just share some of that with us?
Well, they're pretty alarming numbers, Grace. Let's be clear here. Oh, dear. Okay, so on the 0.5% hike that we just had on Tuesday for a $500,000 loan size today, 25 years remaining at the average existing owner-occupier variable rate as recorded by the RBA, we're expecting that someone's increase in repayments for this month alone would be around $133 extra. Obviously, larger loans mean that people will be paying more of an increase. On $1 million loan, that's $265 extra just from this month alone. But of course, as we've been talking about, the RBA is not going to stop at 0.85% cash rate. If the cash rate gets to 2.1%, as forecast by CBA and Westpac in December of this year, the person with a $500,000 debt today could see a total increase in their repayments of $542 every single month. That's like blowing 2 car tires every month and having to replace them. My goodness, I had to replace 4 car tires the other day, and I know how much financial pain that can cause. On $1 million loan, by December 2022, a person could be seeing a total increase of $1,083 every single month. These are big numbers that people need to factor into their budgets.
Definitely. And as we did mention earlier, that should be stress tested into people's mortgage repayments, by their bank. That's the good practice that we've seen come in from the 2018 Royal Commission into banking. So everyone that has got these mortgages should theoretically be able to still pay these, even though the numbers are so much higher. And all 4 of the big banks, they've all passed on these rate rises already now, haven't they, Sally?
Well, they've announced what they're going to do, but they haven't quite passed them on yet. I think that it was CBA, NAB and ANZ. They've said that they're going to pass them on from the 17th of June. Westpac is the 21st of June. So it's coming up soon. What people will see is that the interest they're charged, and interest is charged or calculated rather daily, from those dates, that's what interest rate will apply. But they might not see the actual change come through until their next monthly repayment hits, and that sometimes can take a couple more weeks. And so it really could be July by the time that people are actually paying the June hike in their monthly repayments. But there's no time like the present to get organised, that's for sure.
Definitely not a reprieve, probably the wrong word to use, but a little bit of warning time between here and now for people to start thinking about that kind of thing, Sally. What are your expectations? We've talked a lot about what the big four banks are expecting to happen by the end of 2022. And, you know, some of that has originally we were expecting all these rate hikes to take place in 2023. Where are you at the moment? We're obviously, it's a little bit crystal ball gazing, a little bit rooted in maths and economics, and obviously a lot of data that you have access to. What are your expectations for what the next few months will bring? And are you one of those people that do expect that next month could bring another 0.5% hike?
I do think that we might get another 0.5% hike next month because, as a couple of economists said to me over the last couple of days, well, why wouldn't they now? When you look at what they did on Tuesday, they are prepared to do what it takes to get the inflation genie back in the bottle, and they're trying to rip the Band-Aid off quickly. Yes, it's going to hurt, but they're doing it in a swift, quick motion. Just because they're hiking in double measures now doesn't mean they're necessarily going to go a lot higher than everyone predicted. It means that they mean business. They want to get that job done quickly. You only have to look to the US, where inflation is well above 8%, to know that this can get out of hand and be much harder to deal with if the RBA doesn't move swiftly. So I am predicting that the rate hikes will rapidly increase over the next 6 months. Now, the big thing up for debate is the neutral cash rate. Where will they get to? Governor Lowe has indicated around 2.5% might be right, but of course he's not committing to that at all. And he certainly said that the timetable for getting to the neutral cash rate is unclear, because at every single step of the way, they're reading the data. They're seeing how families and other households across the country are reacting to these rate hikes. They're seeing what wages are doing. They're seeing what, GDP is doing, all sorts of data, and making decisions at every step of the way based on that data. So no one really knows. But 2.5% cash rate does seem pretty normal to me. In fact, there are some economists that think they might go over what the neutral cash rate is and then have to make a few cuts because, it's had a significant impact on the economy. Time will tell.
I love that you brought up then that the RBA will be looking into consumer sentiment and how people actually handle these early rate rises and how that will influence what the bank does moving forward. What's sentiment looking like from where you stand? I feel like you've probably got quite a helicopter view of the industry.
I think that sentiment has certainly been rattled based on Tuesday's news of the double hike and the news that there could be another double hike coming. Although once the dust settles, people hopefully will be able to manage those higher repayments and get on top of it, and the RBA can get inflation under control. But there's a lot of work between now and then to do, particularly when you're looking at petrol prices soaring, grocery bills ballooning. I swear every time you do a weekly shop, the bill gets higher and higher and higher. You've got, unemployment at record lows, but a lot of people aren't yet seeing the wages growth that, is predicted. So there's a long way to go to get all of these things settled down and back into the usual order. And it might be a rocky ride for a lot of people. You did say, as we've talked about a lot, the banks do stress test people's loans, and so these people should be able to meet the monthly repayments, particularly those people that bought recently. Where people might struggle is if they've had a change in circumstance. COVID, over the last 2 years, a lot of Australian households have done a mammoth job of kicking down bad debt, such as credit card debt, of building up rainy day funds in their offset accounts or as extra payments in their home loan or as, savings in the bank. But that is just one side of the story. There are other people that have had the toughest financial test of their lives. They might have had a small business where they've had to shut doors. They might have had a bout of ill health where they weren't able to work, things like that. can throw a spanner in the best laid budgets. And these are the people that could struggle with those higher repayments.
Thank you for being so real with us there, Sally. And I do think, I want to reiterate to everyone, it is an economic cycle. We always have these periods where rates do go up, they go down again. Hopefully everyone is, talking to people that they need to be talking to get through this. And, on the whole, it does feel like a rough ride right now, but more longer term, it does seem like it will settle down. This isn't a forever thing right now.
Absolutely. And if you look at the data, most Australians really are well placed to tackle these rate hikes on the chin. No one's going to like paying extra to their bank in interest. But, if you look at the APRA stats, the average owner-occupier is 45 months ahead on their mortgage. Balances in offset accounts is at a record high. We've got $1.27 trillion in deposits in the bank. These are amazingly impressive numbers. But, of course, they are just averages. There are people that are struggling. But also know that there are a lot of support networks out there to help people that are struggling. The key is to put your hand up, ideally before you can't pay a bill, to ask for help. Bill providers, but also banks have hardship programs. They're there to help people pave a way forward, just to help them pay their bills. The government has, Centrelink has crisis payments available for people in severe financial hardship. Good Shepherd has no interest loans that they can provide people to help them pay, a big expense like a utility bill. I know the New South Wales government has vouchers to help people with energy costs, which are, about set to spike. And then, of course, there's a national debt helpline. We talk to them from time to time. They're fantastic. They put people in touch with financial counsellors around Australia to help. And those financial counsellors can help people work out a plan to get them through what is a tough time. That number is 1-800-007-007. I often say, think of it like James Bond. They're there to help.
Sally, it has been so great to chat with you. I feel like you've really lifted the lid and made it so easy to understand what is going on from an economic perspective at this point in time. So thank you so much. I'm already looking forward to the next time that we can sit down and have a chat.
As am I. Thanks, Grace. Thanks for having me.
To everyone who is listening to this episode, we hope you enjoyed it. Please like or review us on whatever platform that you do listen to your episodes on. Reach out if you have any questions at editor@smartpropertyinvestment.com.au. Stay up to date with us on our social media, Facebook, Twitter, and LinkedIn. That's all we have time for. Until next episode, stay safe and well. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
It's safe to say the property market has been red hot over the last few years, with some of the markets we've selected in 2021 rising over 40% in a 12-month period. It's very likely that if you're a property owner, your property has gone up 20% minimum in value in the past 12 months, and you have most likely accrued sizable equity that can be recycled and extracted to build your investment portfolio. With interest rates increasing, you might be wondering where to invest to maximise capital growth and cash flow in 2022 and beyond. Well, to save you time, energy and guesswork, award-winning author and regular guest on the Smart Property Investment podcast, Paul Glossop and his team at Pure Property Investment have outlined the top 30 affordable suburbs poised for strong capital growth over the next few years with sound cash flow. Grab your free Top 30 Guide to Property Investment guide today at purepropertyinvestment.com.